yeah. From where we left. Remember yesterday, I think we handled part of our tax, part of taxation. And we looked at a question, of course, from our model paper. We looked at a question from our model paper. And of course, that question that we did was for a sole proprietorship, yeah? And we agree that many a times when we are dealing with such questions for taxation, they'll always tend to follow one same concept. That is, if at all you're dealing with the company, if at all you're dealing with partnership, if at all you're dealing with this case of course, sole proprietorship, it will always follow one similar concept. And that is an area to do with what? An area to do with the format. The most beautiful part with the marking for taxation is that they'll always consider the entries. So try as much as possible to have as many correct entries as possible, because in this case, you'll find that they will consider these entries. So as many entries as you have, try to have as many entries as much as possible. That will help us a lot. That will help us a lot. That will help us a lot. So our target today, I want us to look at auditing part, and also we look at, we just do a review on what we did under the capital budgeting, so that our target would be, we look at this case, I take it through the concept of audit. Then of course, if at all time will allow, so this one I plan to do it over probably as our last bit, but if time will allow, I can touch something on that, so that in relation to MA, CVP concept, the concept of even, can also have a look at it. So straight away, we start with, we go to this question number 1, the aspect of financial management. At this point for financial management, if you are to be tested, yeah, if you are to be tested on this, we will never miss, or the concept, it is either you are being tested on aspect of the capital budgeting techniques that we looked about, that is NPV. Of course, talk about IRR, maybe profitability index, and discounted payback period. You can also be tested, of course, when it comes to the NAN, talk about what we refer to them as non-discounting. And majorly, in this case, we normally tend to talk about, of course, the aspect of accounting rate of return. Remember, there's a question that we did for that. The accounting rate of return, and probably the aspects of accounting rate of return and the normal payback period. Many a times in this one, of course, we can check with all these questions that have been tested. Many a times for financial management, it will always be very easy for you to know what might be tested, because the whole concept, you'll find that will always go around those areas, right? We'll always go around the areas. We'll always go around those areas. And that's why it's always very easy for us to know area that might be tested. So long as you're perfect on all these areas, then there's no question that you cannot handle when it comes to financial management and business data analytics. So at this point, I want us to do a quick review on all these methods, yeah? And doing this quick review, you'll find that we are going to handle it with a question. Yeah. See, we're going to handle it with this question that you're given. You told us Cწ𝗹𝗹 Limited manufactures a component known as TAP. This is a block model paper, question number 21. Yeah, and some of you have attempted. That is very good. That is very good. Some of you have attempted the questions. That is very good. So I know for now you'll just be revising because for those who have attempted the question. So you're told that xCELL manufactures a component known as TAP Limited, which is used in the manufacture of locally assembled desktop computers. While the current production capacity is 1 million, currently, we are producing 1 million units of TAP. Demand for the component is expected to be as follows. This is the demand for this component. The company is planning to acquire an additional machine at a cost of 8 million. So the risk aspect or this item that you're planning to acquire, a machine over 8 million, which will have a useful life of 4 years and a maximum output of 600,000 units. The maximum level of production that this machine can give us is 600,000 units. The scrap value of the machine after 4 years will be 300,000. The current selling price of TAP is 80 per unit, and the variable cost is 50 per unit. Other variable costs of production are 19, and of course, other variable costs of production are 19. The current selling price of TAP is 80 shillings per unit, and the variable cost is that one we've looked at it, yeah. Fixed cost of production associated with the new machine will be 2.4 in the first year of production, increasing by 200,000 per year in each subsequent year of operation. Very good question. Fixed cost of production associated with the new machine will be 2.4 in the first year of production, increasing by 200,000 per annum. That one we've looked at it. xCELL pays. xCELL pays 1 year tax, 1 year in arrears at an annual rate of 30% and can claim capital allowance on a 25% reducing balance basis. A balancing allowance is claimed in the final year of operation. So the cost of equity of xCELL is 10%, while it pays an interest of 8.6% on its debts. Its long-term finance is made up of 80% equity and 20% debt, not fiancé. That is finance, right? Should be corrected, finance. So that is finance, yeah? It's made up of 80% of equity and 20% of debt. Required, calculate the net present value of the net present value of buying the machine, of buying new machine. Calculate the internal rate of return of the new machine. Advise the management of xCELL on whether to buy the new machine. On whether to buy the new machine. So, at this point, it is important for us to note that NPV, taking you back, all that we are looking at is simply the difference between our annual, or rather talk about the present value of our cash flows minus our initial outlay. This is what will give us our NPV, initial outlay. Another concept is that the cash flows that you're talking about here, you see the cash flows that you're talking about there? These are annual net after tax cash flows. Annual net after tax cash flows. And looking at the annual net after tax cash flows, we should always recall that you're talking about our contribution with less our fixed costs, with less any form of tax. We're going to add depreciation tax shield, we're going to add any working capital recovery as at the end of the period, plus of course what? The residual values at the end, plus residual value as at the end of the period. So these are what you need to understand anytime you talk about what the annual net after tax cash flows. So compared to the questions that we've been doing, this one had a component of course, we are not given directly. It was asked, or rather it would be upon us trying to work out all these items, right? So having that in mind, we will be required then to determine this case. Look at the item that you're given. We are not given the cash flows, so it would be upon us to determine these cash flows. So how will you go about it? We look at the years, year 1, 2, 3, 4. So the years given here, we told we had year 1, year 2, year 3, year 4. What is our demand? Demand in units, in this case, we're told that our demand, you're given year 1, that is 1.4. Excel will not consume more space, so we just take it the way it is. We're given 1.4. The other part, we're given 1.5, 1.6, 1.5, 1.6, and 1.7. This is what you're given. But again, look at what you're told. That while current production capacity is 1 million units, current production capacity is 1 million units. So that is to say that this is what we're having in existence, meaning that the new machine, the one that you're bringing in, where we are told that the company is planning to acquire additional machine at a cost of 800, which will have a useful life of 4 years and a maximum output of 600,000. If our current production capacity is 1 million and demand is 1.4 as per what you're given there, meaning that demand level for this new machine, talk about units that this new machine will bring into us or expected to bring, should be having what? Excess demand, that is excess demand as per production. We have that minus that value. So new machine is expected to give us what? The excess demand would be catered for the new machine, or simply you can have this case, this excess demand. Excess demand, that is why we are having, or that's the reason why you are purchasing what we want to take the new machine, to consider or to cater for the excess demand. But on the same sentence, you're told that the maximum output that this machine will give us is only 600,000 units. It's only 600,000 units. So what is the demand associated with this new machine? Demand units associated with the new machine. This is what we will have, of course. These are what we'll have, demand associated with this new machine. Yeah, demand associated with the new machine. These are what we'll be having. We take the whole value here, yes. But remember, our maximum production for this new machine is only what, 600. So where we have our demand level of 700, this new machine will not solve that. I only have up to what, 600,000. The maximum capacity. The maximum capacity. The maximum capacity. The maximum capacity of this new machine is only up to 600,000. So we know from there we can determine our contribution. And if at all we can go back to what Mwalimu guided us, remember, anytime you're talking about contribution, recall, we are looking at the difference between our selling price per unit minus variable cost per unit. Determine this, we multiply by what? The quantity. This is what will give us a contribution, the knowledge that Mwalimu shared with us. And at this point, you can also agree that our selling price per unit minus variable cost per unit will give us what we normally refer to as what? Contribution margin. You see? This part here, without the quantity, this will give us what? Our contribution margin. So it is upon us, if at all you want to determine our contribution, because we have already determined our units, we can easily come and determine our contribution margin. You take a selling price per unit, selling price per unit, and variable cost per unit. Variable cost per unit. As per our question, selling price per unit, we're given 80. So 80 all the way. 80 all the way. Variable cost per unit, we're told that other variable cost of production, we have 19 plus the variable cost is 50. So we have 50 plus 19, which in this case will give us a total of 69. So we have 69 all the way. 69 all the way. These are variable cost. So therefore, our contribution margin, we are going to have selling price minus our variable cost. Selling price minus our variable cost. That will give us what? Our contribution margin. Once we have determined our contribution margin, our work will even be much easier. Why? Because we can easily determine our contribution. We can easily determine our contribution. So what about our contribution? Our contribution now would be our selling price per unit, or rather our contribution margin. We multiply by the units here. Remember, we are looking at the demand level of this new machine, because that is what we need to make decision on. We need to make the decision on this new machine. So this is to say that our contribution will have the quantity times our contribution margin. In that, this will give us, of course, our value of what you're having here, contribution. That will give us what? Our contribution. So what we've done, we just analyze the question the way we were given. We just analyze the question the way we were given. And this is a concept that 𝗪𝗵 had already shared with us. So after that case, we need to go ahead and consider our item of fixed costs. What about the fixed costs? This note, fixed cost of production associated with the new machine would be 2.4 in the first year of production, increasing by 200,000 per year in each subsequent years. So year one, we have 2.4. Increasing by 200,000. So 2.4 plus the 200,000 should be increasing by that value all through. So that by the time we reach year 4, we should be having what? That value there. That will give us what? Our fixed cost. To determine our profit before tax, to determine our profit before tax. Just a moment here. At this point, we have this case, our cash flows before tax. Cash flows before tax, or simply profit before tax. Yeah. We have contribution minus fixed cost here. So that this is what we will be having there. So that is what should be having at that point. Now, this is where these questions are interesting. Yeah, these are where we had a very interesting part on this question. Because look at this case. A good examiner told us that you know what? We are going to tax you. The taxman will be taxing us at 30%. But it will be in arrears. This is not accounting. So therefore, we consider when this outflow is happening. We consider when this outflow is happening. So therefore, we need to determine that. Our outflow, it will be in arrears. So talk about tax. Tax for year 1, I'm going to pay in year 2 because it is in arrears. Tax for year 1, I'm going to pay in year 2 because it is in arrears. Tax for year 2, I am going to pay in year 3 because it is in arrears. Similar to this, and that is to say, a 𝗪𝗪 extension, which this component of tax, it will be paid in year 5.
𝗪𝗪. Sorry.
Yes.
I mean the contribution for year 4.
Yeah, for contribution.
Yes, is it supposed to be the same with year 3 or is it supposed to be different?
And that's why you said, in this case, our maximum, I think you're not joined the class yet. But that's why you say that at this point, look at year 4. Year 4, what was the excess demand?
It's 700. 700,000.
And what were we told? What was the maximum capacity that this new machine will give us? Look at this statement. The company is planning to acquire an additional machine at a cost of 8 million, which will have a useful life for 4 years and a maximum output of 600,000. So this new machine cannot surpass what? Production of 600,000. Is that okay?
Yeah.
Great. And that's why we've also capped it here to 600,000. Okay?
Okay.
Great. So these are our, of course, what? Tax. We need to pay these taxes. And they were paid, of course, in arrears, as what you've seen at that point. So therefore, consider cash flows after tax, simply PAT. But in this case, after having this,
Mwalimu,
yes, please.
allow me to interject. When we were calculating the net operating cash flow, we have been told that this machine has a useful life of 4 years. Should we have determined the depreciation cost for purposes of tax hapo juu alafu ndio we add back hapa chini?
That is also another way. And that's why we talk about what? Depreciation tax shield. See, depreciation tax shield. That is what you're going to consider. Remember, I think in class we said you can either consider these two methods whereby you add back depreciation, then you less depreciation, then you add it back. The easiest way is always to work with what? The depreciation tax shield, to look at the net effect. So you're going to use the two methods, then you're going to select which one will fit us best. Okay? Because depreciation is always for the component of what? For the component of tax affecting our tax component. So that's why we need to consider then the depreciation tax shield, which, if at all, you can see this is what we have. For us to determine our annual net after tax cash flows, we take contribution minus fixed cost minus tax plus depreciation tax shield. And that is what we need to consider now. So for depreciation tax shield, the most beautiful part with this question is that, again, we are given on reducing balance basis. We are given on reducing balance basis. That is what you are given. So let us work out our depreciation. So for depreciation, of course, consider our years. That is year 1. Year 2 all the way to year 4. Year 1, year 2 all the way to year 4. The cost of this item, which will run as the net book value because it is reducing balance. We have our depreciation here. We have our NBV. The cost of this new machine. This new machine will cost us 8 million. So we have our 8 million here. Depreciation is on reducing balance at the rate of 25% as per what you are given in this statement. 25% reducing balance. So we come and take 25% times our case. So our NBV will therefore be that minus that. Consider year 2. Our net book value would be the 600. Our rate still 25%. Our book value will be that much. And year 3, this is what we'll be having. Depreciation 25% value, the same case. Reducing balance basis. Reducing balance basis. We've achieved that target. Year 4 now. Year 4. Cƙ𝗹𝗹 pays 1 year in arrears at an annual rate of that and can claim capital allowance on 25% reducing balance. A balancing allowance is claimed in the final year of operation. A balancing allowance is claimed at the final year of operation. So, what will be our value as at the end of this year, the final year of operations? Original cost was 8 million. Our residual value, we are given a value of how much? The scrap value of this machine was 300,000. Up to the beginning of year 4, this machine has depreciated, and the value that we have up to that point was how much? The value of depreciation, we are having 46.25. So therefore, the balance of this machine by the time you are in year 4 would be the cost 8 million, will less the residual value, will less the accumulated depreciation. So that this is the amount that we should be having as at the end of year, as at the beginning of year, for which we are going to claim it, the whole of this amount on that year, as per what the good examiner had told us. So we are going to claim the whole of this amount. We are going to claim the whole of that amount in year 4. We are following this statement here. You're following the statement that you're given there clearly. The Cƙ𝗹𝗹 Limited pays a tax 1 year in arrears at an annual rate of 30% and can claim capital allowance on a 25% reducing balance basis. A balancing allowance is claimed in the final year of operation. So balancing value, the balancing allowance, whatever that has remained, we're going to claim all of it on the final year of operations. So we have it at that point. So depreciation tax shield. Remember, Mwalimu told us on, or gave us the concept of depreciation tax shield. Depreciation tax shield in this case, remember, we said at all times. Yes, please.
Please repeat the part for year 4, kindly.
Sure, no worries. So year 4, we say that based on this statement that you're given, that Cƙ𝗹𝗹 pays that tax, then you told like the last statement, a balancing allowance is claimed in the final year of operation. So we need to determine year 4, what was this value of this machine that has remained. So that's how we've taken the cost of this machine was 8 million. It had a scrap value as at the end of 300,000. Accumulated depreciation of this machine is the depreciation that we've counted up to year 3, which you've seen is 46.25. So the value of this machine that we have remained with in year 4, the value is how much? 30.75. And we are told that we are going to claim all this. This is a statement where you're told that, now a balancing allowance is claimed in the final year of operation. So determine the balance value of the machine is how much? 3075 in year 4. And we are going to claim all of that. So that's why we're taking 3075. Is that in order? Believing that now you've gotten that answer, right? Great.
Thank you.
Welcome. So you're saying that depreciation tax sheet, if at all you can recall what 𝗪𝗵𝘁𝘀𝗽𝗽 said, that anytime you're talking about depreciation tax sheet here, this is what you must always remember, that at all times we have to take our depreciation times our tax rate. Where now our depreciation tax sheet in this case would be depreciation times the tax rate that you're given. And the final year of that. So this is what? Our depreciation tax sheet. This is our depreciation tax sheet, what we should be having. So having our depreciation tax sheet, we know very well that this will affect, it will go hand in hand with the component of what? It will go hand in hand with the aspect of what? The aspect of tax. So therefore, this will also be in arrears. So that the value for year 1, depreciation tax sheet, you're going to have it in year 2. 1 for year 2, we have it in year 3. 1 for year 2, or rather for year 3, we have it in year 4. And of course, we have this claimable in year 5 because they are in arrears. They are in arrears, depreciation tax sheet, which we should add the same value here. We're going to add that value. So that in this context, we should have the aspect of our cash flows at that point. Consider if at all we had any other item of working capital recovery. Working capital recovery and the residual value. In our case, we didn't have any working capital. But we had, of course, our residual value at year 4, which was how much? The 300,000. This is a cash flow that I'll be receiving on disposing these asset of ours. That is what we'll be having. So on this case, we can easily then determine our annual net after tax cash flows. So we get the summation of up to this point, of up to that point. So that as at the end of the day, these are what we'll be considering as our what? Cash flows, like annual net after tax cash flows. The value that we should discount. The value that we should discount. So this other method that Jeff was telling us, but I told you guys that as many, you can always use depreciation tax sheet to make your work much easier, because many students will forget to add back the depreciation component. So another way that you can work this one out is by considering this case. So you take all our values up to the fixed cost. Up to your fixed cost. But because of the arrears, also this other method, you might go a long route. So while here, after deducting our fixed cost, we can come and consider our aspect of what? Depreciation. We can come and consider our depreciation, one that we have computed here. So you come and take your depreciation directly. Come and take your depreciation directly here. Depreciation. You come and consider your depreciation here. You come and consider your aspect of depreciation. The last year we had this value. 30, that value that we have there. The value, the value that we have just determined right now. This is 30. Come and have it here. So that you determine your profit before tax. So this is depreciation. So that we have it at this point. But so long as in this case, you know the effect of the depreciation tax shield, or the effect, why do you normally consider depreciation? For the purpose of tax, for the purpose of tax. So that's why I'm saying at this point you should be very keen, because you'll find that this depreciation, you'll consider them in a case of what? In a case of aspect of accrual, that is on accrual basis as well. On accrual basis
allow me
as
to
well.
ask. Allow me to ask. As you have said that we consider depreciation for purposes of tax.
Exactly.
So depreciation for year 2. Will we consider it for purpose of tax for year 3?
That is correct.
So we'll consider depreciation for year 2 for purposes of tax for year 3.
Year 3,
when
exactly.
We are computing tax for year 3. Wow, that's quite complicated.
But if at all you use this case, you see, the concept of depreciation tax sheet is very okay. Or better still, you can work out exactly the way it is, and you carry forward. Like this is what you're saying. That's why I always wanted us to avoid this case, because majority of the students will find that alternatively, this is what you can do. Let me show you, like how you can work it out. This is an alternative, a very long route that you're going to work. So talk about our tax. Talk about our tax. So tax, of course, will be based on these cases, profit before tax. So therefore, At this point, you'll find that we won't be having any. So times that value there. Work it out the way it is. See? So that our PAT, this is always a very long route. You come and consider your profit before tax minus tax component. Minus tax component. Then you come and add the aspect of depreciation, where depreciation in this case, remember the tax component again will affect us in a way. So you come and add it at this point. See, you add the component of what? The aspect of this component of tax. So that as at the end of the day, you'll have this point. I'll sign or just take part plus our depreciation component, where we will be adding it on this end. Only that at this point now, if I told you to use this case, you'll find that this component of tax, it was done in arrears. So that at this point, you'll have again to work out what was the tax component of this case so that you can carry them, for the next year, which again will be a very complicated item. So you'll find that if at all it was just any other question without the component of arrears, then these cash flows will just be the same. If at all use what? The component of depreciation, tax shield. The component or the tax rate will have just been the same. But because we have this case, you'll find that the carry forward component, then it will have to affect you directly. Because remember, the profit or the tax will be deducting it on the component of profit that we earn, But if you do this case, that is to say year one, you won't be having any tax to pay. And that case will affect the component of in arrears. If at all it was any other question, then the values will just be the same. The value will just be the same. The value will just be the same. The value will just be the same. Which that's why I was saying earlier on when we started, this depreciation for the component of tax, if at all you are to use that method of ours, or rather this method, then you need to make sure that this is in arrears, which many students again will not be able to mark or to get that directly. See, many students wouldn't gotten that directly, so that they can consider that this is a component of what? This is a component of arrears. Many students hawangepata hiyo. So this one, you can use this method if at all it was just any other question, which would be very, very okay, which would have been very, very okay, because the value that we get, it will always just be the same as whatever that we've used for depreciation tax sheet. So in the case of arrears, for the purpose of tax, then the formula of depreciation tax sheet will work very well. Take, for example, this case, so that probably it should also settle very well. We get rid of the aspect of this depreciation tax sheet, or rather not but the component of arrears, assuming we are doing this question without component of arrears, assuming we don't have arrears. What will we have? If we don't have arrears, see how this will work. Assuming we don't have arrears, that is the assumption. We take the two cases. We take the two cases up to the fixed cost here. We take the two cases, assuming we don't have arrears. Assuming we don't have arrears. Assuming we don't have arrears. This is what we'll have. The person who will work with the component of depreciation and the person who will work with the component of what? Tax shield. Okay? So, depreciation, you come and take our values that we have determined, exactly the way we have determined our values. You come and take the depreciation. You come and take the depreciation. Here we go. We come and take our depreciation. Year 4, these are depreciation. We come and consider our depreciation. Okay. So profit before tax, we less that. We come and consider our tax, 30% times our value there. We say that in this context, we assume we don't have the component of arrears, so that we have our value at that point. Part that plus that. You come and add back depreciation. Come and add back depreciation, so that our cash flows here would be that plus that, adding back depreciation, yeah? This would be our cash flows. And this other person uses depreciation tax shield, so that depreciation tax shield, after all this, I come and consider that is our tax component, which will just be the same. I come and take our tax at this point. Okay? So tax at this point will be 0.3 times our value there. We have it all through. So having our tax, consider our PAT, that minus that component of tax. We have 1.4 all through. Part, we come and add depreciation tax shield, our DTS. So what would be our DTS in this case? Our DTS, as per what we computed, these are our DTS. These were our DTS, right? So DTS, we come and have it here. Our DTS, come and have our DTS at this point. Come and have our DTS at this point, right? This is 600 all through. So I take these plus, of course, what? The value DTS as at the end of that period, we saw we had what? A value of 922. So we come and add our DTS here. See? So having that case, determine our cash flows as at the end of the period. So we'll have that value plus this value. And compare your cash flows. See? Compare your cash flows here. See? Compare, take this one, and you compare it here. See? So that we have that one and that one there. See? You run all through. You see? So you'll find that that will always be the effect of what? Of the aspect of the depreciation tax. Depreciation, the whole idea is always for the purpose of the aspect of tax. And that's why in this question where you're given in arrears, you'll find that yes, you could have used, or you can use this, but you will go a very long route. You'll go a very long route. It was Jeff who asked the question. Was it Jeff? Jeff, have you seen how the effect?
Yes, but of course the question still remains to be a very tricky one, even after you have explained.
This one you said we assume we don't have in arrears. What is the tricky part on this? Assuming we don't have in arrears?
No, if we don't have in arrears, it's very straightforward. But exactly. You see now, my main challenge with this is that from the standard FM that we learned earlier, we know that if we want to get the net operating cash flow, this formula is earning before depreciation and tax in bracket 1 minus T, and then you add the depreciation tax shield. But now that depreciation is being charged at a different tier, it also brings now a lot of complication. So I don't know whether if I just use that particular formula in this, the reduced formula of the net operating cash flow of EBIT earning before depreciation and tax in bracket 1 minus T plus DT in this, whether I'll still get the same answer. But anyway, at my free time, I'll be able to see if it can
work it out. So long as you've considered in arrears appropriately, then you just will arrive at the same values. If at all you just considered what? The aspect of in arrears appropriately. Because arrears, that is where the issue was. But you should be having the same. Yes, go ahead.
And then also the another challenging or tricky part of it, that depreciation is being charged on a reducing balance basis. And they have given us the scrap value of 300,000. When you do when you do the straight line basis on the final year, you are getting that the value, the net book value of that asset is 253, 1,250. So I don't know whether that one is now makes some sense, but I don't know. I'll still look at it.
Check it out. But remember, like in this case, what is the essence of scrap value? At what point will scrap value occurs? At the end of the
final stage. Yes.
At the final stage, right? So
yes.
The reason why, if we are using straight line basis, if I told you to use the straight line basis, this would have been the case, normal case, because it is a constant depreciation over the years. We could have taken our cost minus the scrap value that you're having. Divide by what? Estimated useful life. This is straight line basis.
Yes,
right?
Yes.
So that our straight line basis depreciation will be charged at the same value or say constant amount all through. The reason why you need to determine that for these 4 years, what would be the book value of this asset? That's why we normally deduct scrap value as at the beginning. So that you'll find that in this context, if it was a straight line basis, you could have taken the 8 million there with less the aspect of scrap value, then you divide by the estimated useful life of 4 years, where our constant depreciation over the years will therefore be, of course, our value of that. In this case, we'll be getting that divided by 4 years. So depreciation that I'll be charging on an annum per annum basis, it will be constant value of 1925. You see? So when you're considering now our reducing balance, remember reducing balance, it is based on the cost of this asset when you are starting. Considering that when we reach as at the end of the year, now is when we'll consider what? The scrap value. Because this depreciation will not be the same over the years. And that's why in our working here for depreciation, if at all you followed it clearly, we can clearly see that our book value, or if at all you can tell me the cost, it was not the same over the years, it was varying. But come the end of the year, because I know very well, is it at this end is when, of course, I need to get rid of this machine completely. We have to decommission it completely. And through this, I'm going to sell this machine. And this value that you're selling this machine is not part of what I should claim for depreciation. So that's why we've gone all through up to the 4th year. The 4th year, we realized, now I want to determine what is the value of this machine now, the one that I should claim, the one that I should charge depreciation. That's why you consider the cost, you less your accumulated depreciation, then you less this scrap value as at the end. So that if I told you to look at the value of this machine now, considering all the deductions, I'll be having 3075. So that is where the difference will come in, Jeff. Understanding the concept of scrap value. What is the essence of scrap value? And which method are we using for depreciation? I don't know if at all I've given you an insight on that.
Yes, a lot of it. Thank you very much.
Great. So always consider, always ask the reason, the why. Like the same case I've told us that the effect, the reasoning why we normally tend to add back depreciation whenever you're doing our cash flow is that, number one, we know very well that, this cash flow, I need to get rid of what? The non-cash item. Amongst the non-cash item is a component of depreciation. And what will affect us here? It is the tax effect on the non-cash item. And that's why we normally determine the cash effect on this non-cash item. And we add it back. Why we are terming it as what? The tax shield. That's why we normally term it as what? The tax shield is like a saving in a way, but in this case now relating it what? To aspect of our tax. Aspect of our tax. Aspect of our cash flows. So that's why we need to determine that. So I remember in class when you were doing the NPV of this, I told us that at this point, this other method, I always avoid it as much as possible, because many students, most when it comes to adding back depreciation, many of them, they'll not. But if at all you work with depreciation, actually you clearly know that, I just need to do what? I just need to add the depreciation tax shield. So that is very important. The rest were for our knowledge. In this case, we don't need all this. So let me have it erased. So that is what you should have. So now, this is what we need to consider. That at this point, you have determined our annual net after tax cash flow. This is where we are. So we have our values considering our case. We'll have it at this point. So our cash flows, I'll just have it here. I transpose like that. See, so we're having our years at this point, year 1, year 2, all the way here, year 3. So these are period.
Mwalimu, before you move on.
Yes, please. Cash flows,
Okay.
yes.
Yes, my internet has been messing me up kidogo. Now, there's this bit, there's this last sentence on the question that mentions on the interest rates and the long-term finance made up of 80% equity and 20% debt. Now, have we considered this in our cash flow? Or at what point?
No, because that point you're going to consider it when you're determining what? The present value. Okay, because remember, what is NPV? NPV, we need to consider the present value of our cash flows. So that one you're going to consider it when computing the present value, because for present value, you must have what? You must have a factor. So that one you've not yet used it, you're going to use it, okay?
Okay. Okay.
Great.
Okay.
So these are what we have, and I will consider it at that point. Now, having this case, yeah, you can have year 0 here. You can have year 0. So having this case, our initial outlay, we had a value of 8 million. So we know very well that I need to work out our NPV. And NPV, as we have stated clearly here, see, that we need to determine the present value of our cash flows, present value of our cash flows. And anytime, whenever we do about the present value, remember Mwalimu gave us all these concepts from scratch. When you're doing FM, of course, in BDA, we said that it will always be upon us to look at our case and identify the annuity or lump sum. Lump sum, we are going to use the lump sum formula where our cash flows are irregular or simply unequal. This is what we said. We're going to consider annuity concept when our cash flows are regular, meaning that they are equal. This is what we said. So in this context here, we need to determine on all these, I must be having a discount factor. We must have what? A discount rate to use. The discount rate to use. We must have the discount rate or the minimum required rate of return. Minimum required rate of return. This one you must have it at some point. See, for us to work out the NPV. And that's why even in our formula, if at all you can check your NPV function, in this case in our Excel, the NPV function, if at all you do the NPV function, we normally consider the rate. See, we normally talk about what? This rate. This rate, we normally consider this rate. So this rate, we don't have. This rate, we don't have. We've not been given in this question of ours. And the fact that we are not given in our question, how will we go about it? Should we leave the question and tell the examiner that you have not given me this, so I'm not going to compute this question with yours? No, he has given us a lead. And this lead, it is in this note. That the cost of equity for Cწ𝗹𝗹 is 10%, while it pays an interest rate of 8.6% on its debts. Its long-term finance is made up of 80%. equity and 20% debt. So at this point, it will take us back to what we did some ages back, the concept of WACC, weighted average cost of capital. The weighted average cost of capital, recall that this is a combined cost of raising these funds. The whole idea of capital budgeting, we want to finance these projects in the long run. And to finance these projects, I'm not going to finance these projects for free. I have to incur cost on finance. And the cost of financing this project, I'll have to source it from different areas. I'll have to consider different areas. I have to consider different areas so that once I have considered these different sources of funds, the sources of funds is now that as at the end of the day, we will now be required to do what? To look at it in the case that, what is the average cost now? What is the average cost of raising all these funds? That is what we'll be looking at, the average cost of raising these funds. And the average cost of raising these funds, we know very well that now that is where the WACC will come in. So determining the WACC, in this case, we'll consider the following. That, number one, we have to consider the weight of equity times cost of equity. We add the weight of debt times the cost of debt. The cost of debt should be after tax cost of debt. We need to add weight of preference shares times the cost of preference shares, KP. So this will give us what? The combined cost of raising these funds to finance our project. WE is simply entails weight of equity WD, this entails weight of debt WP, this entails what? Weight of preference shares. See? So this is what you need to have in mind. Whereas KE simply entails cost of equity we're having KD, this entails what? Cost of debt. And we have the other value here, which we're talking about what? KP. KP will simply give us what? Cost of preference shares. Cost of our preference shares. See? This is the case. 1 minus T, T symbolizes the component of what? Our tax rate. T symbolizes the component of our tax rate. T symbolizes the component of our tax rate. So we have cost of equity, cost of debt, cost of preference shares. Very important to note. So the WACC is now what we are looking at here as what? The minimum required rate of return by our investors. And our investors, in this case, you can see we are given equity and we are given debt. So we need to determine that cost now. So the cost we'll take as what we are given, The cost of equity for School-TAP Limited is 10%, while it pays an interest of 8%, 8.6% on its debt. Its long-term finance is made up of 80% equity and 20% debt. So in our case, clearly, we are given these values. We're given cost of debt. This is what you're given here. And we're given our weight. We're given our weight here. See? So KE, you're given 10%. KD, cost, we're given 8.6%, but I need after tax cost of debt. So I'll have 8.6%. I multiply by 1 minus T. 1 minus 0.3 to give us what? After tax cost of debt. Where this case will give us what? The percentage that you are getting there. Weight of equity, we are told that in this case, our equity, its long-term finance is made up of 80% equity and 20% debt. So 80% is equity, 0.8, and 0.2 debt. So we need to determine then our what? WACC. So my WACC, this one, therefore would be a WACC. Therefore, we are going to determine. Yes, please.
The KD is 6% or 8.6?
After tax, cost of debt, remember? Okay. So you multiply by 1 minus 0.3. Okay.
Okay, thank you.
Great. So once we have this, we have everything now. We simply take KE, that is a cost of equity times weight of equity. We add cost of debt after tax times weight of debt, so that our WACC, we have this value that we have there. WACC. WACC, this is now what we will be having there. See? 9.20%. That is what you should be having. That is what you should be having. So once we have considered that, we can now easily come and say that, you know what, my good examiner, I'll give you our NPV. I'll give you our NPV. So our NPV, therefore, in this case, we have what? Our formula now we apply, equal sign, NPV, tab, our rate is what you have determined there, comma, our value, we take all these values that we've earned over the years, then we less what? We less our initial outlay. Then we less our initial outlay. so that our NPV should be having that case there. 935, 161.10. The good examiner has also asked us to determine our IRR. So again, no need of struggling. So you want IRR? I was taught how to determine IRR without struggling. So we have IRR equal sign. In this case, come and show the examiner. Actually, in this case, you can always indicate that you're using the function so that you have it there. NPV function, IRR function is important. Using that. So that having this case, it will, again, it's just a matter of using our function where we know very well. I'll be having equal sign IRR tab. One thing that will guide us, of course, so any can work, but at this point you can see that our value is positive. So my NPV value, the one that we used to compute our original NPV, we had a positive value. So you take all our values here, first of all. So the rate that you're supposed to guess, should always be higher than the one that was used to compute what? Our original NPV. Should be higher than the one that was used to compute what? Our original NPV. In our case, our NPV, we had 9%. So you can decide to take, we can guess, see the guess rate, because it's trial and error, you can guess say like 20% or any value that is higher than 9%. You can take 10, you can take 11, 12, 13, 14, so long as it is higher than that. So after all that, you just enter and you have your IRR to be the value there, 14%, 14.11%. See? So you have your IRR. Remember, even if you work it out, and assuming in this case, you just do it directly, take any other rate, say like 25%. See, you still get the same value. Assuming you don't take any rate here, though I wouldn't advise that, because practically we normally consider you must guess a value. So if you don't take any rate, you still get the same value because it has assumed that your rate is 0. But majorly, when you're doing it practically or manually, you'll find that you should always take the rate that is higher than the one that was used to compute what your original NPV. So our IRR in this context, we have what? 14%. In this case, we were asked, I think, in this case, we are supposed to also consider, you're supposed to consider the chart, the IRR, determine, in this case, calculate the internal rate of return of the new machine using a chart. This question was supposed to be using a chart. Using a chart. That was supposed to, for us to use a chart. Using a chart to determine our IRR. It's supposed to be use a chart, determine what your IRR. So this is how we can go about it. Determine IRR using our chart. This is how we'll go about it. Okay. So all this, let me just have that. So IRR using our chart. In our understanding of IRR, we should know that IRR is a rate that will equate our NPV to be equal to what? To be equal to 0. Our IRR is a rate that will equate our NPV to be equal to 0. So, given this range, we've determined our 14%. So, we need to look at what rate will equate our NPV to be equal to 0. So we have our rates here, a guide. In our case, our cash flows, we've already determined our cash flows at that point. You have rate, we have our cash flows here. Or just have them at that point where we are. So we have our NPVs. Rates and NPV. So we can either consider a range of what? From 0%, increasing at 2%, plus 2%. Maybe you can consider 4%, whatever that, maybe you go up to 20%. Because anyway, it is Excel space, so it won't cost us anything. So these are our rates. Yeah, being our rates. We want to consider our NPV at all these rates. We want to consider our NPV at all these rates. Consider NPV at all these rates. So how will you go about it? Our formula will save us here. Equal sign NPV tab. Our rate, that is the rate that you're looking at. What about our values? Comma, our values, these are our cash flows. And we can lock these values. F4 to lock the values, comma. Initial outlay is 8 million. So you can just do, of course, our 8 million minus 8 million. I want us to achieve that. The reason why you've locked is to make our work much easier, so that I just drag this one all through, which will give us our different NPV at different rates. So our NPV at all these different rates is what you're having. Our NPV at different rates. This is what you're having here. NPV at all these different rates. You can see, so long as you make sure that your lock value is operational, so that if at all you click here and find that it has literally fetched our values of income there. See, it has literally fetched our values here, whatever that we've considered, it has fetched our values at that point. So we take this, insert recommended chart. In this case, we can use the line chart. To consider our line chart. So it is upon you to consider your design, one that you'll find it is suitable in your eyes. This one is purely upon you. This one is purely upon you to look at one that will be pleasing in your eyes. Yeah, you can select as many choices as you want here. You can select as many choices as you want here. So for me, I'll select, for me, I can select this. You can select any graph of your choice. So that at this point, we can literally show where our NPV is equal to 0, right? Where our NPV is equal to 0. So it is somewhere in between here, 14 point something. See? Where our NPV is equals to 0. Our 0 NPV is here. So where my NPV is equals to 0 is at 14 point something. And that is why you can prove with the value that we got here. If at all there is to be more accurate, you can find that that was a 14.1110, that percentage value there. But so long as you've indicated it here, you can just come and, of course, argue our NPV at 0. It is somewhere there. It is somewhere at that point. Where it is 0. Where it is 0. So you can have it at 14%. So you can just come and indicate a point where our NPV is equal to 0 without going with a lot of struggling. You can just have it at this point. It is somewhere at that point. You just indicate to show the examiner that you attended the class. Yeah, show the examiner that you attended the class. So that is 14. You can literally come and take whatever that you've computed here. Yeah, but have it in form of just have it there, right? 14.1%. So, and there you go. So it is very important to note that. What if we are dealing with such? See? So this is our IRR. That is our IRR. So that question wanted us to use, of course, that to show where our IRR will be. Any question on that? Where you feel like Mwalimu should explain further? Where you feel Mwalimu should explain further, this is the best time to ask.
Mwalimu, if you go back kidogo to from the beginning, not necessarily IRR, I want to see your contribution. You are using which units?
At that point?
Yes. You used the estimated demands, or what did you use?
No, the demand that the new machine will give us.
600.
It is not 600. It is like for year 1, it is 400. Year 2, 500. Year 3, 600. Year 4, 600. Because we cannot surpass the 600, and that's why, because year 4, you see the excess demand was 700. But the one that this new machine could give us is only what, 600.
Okay, so ni hapo tu nilikuwa na tofauti na wewe kidogo.
Kindly correct that.
Okay, thanks.
Great. So this is what we should be having. Yeah, clear that, clear that. NPV, a very interesting area. Mm-hmm. Any question? Any question on that? Great. Yeah, so that is the first case that we needed to understand, whereby this question is very good. It covered a lot of things actually, so that even if at all you are to be given a similar or a question close to this for NPV, I know it has given you an understanding of the thought process, because that is what you want to achieve. What would be your thought process in handling a certain concept? That is what you wanted to achieve. Victor, any question? Victor, any question? Great. Samuel, any question?
Yes, Mwalimu.
Yes, please.
Mine is just to understand. You took the years up to 50th year. So my question is,
exactly,
are we claiming that 50th year cash flows in the 4th year? Why have we taken the 50th year?
The reason why you're taking the 5th year, it was as a result of these arrears that you are paying. And that's why you say that this question had that component, because of the arrears. Remember, even if we are closing the period, there are amounts that we need to spend or to cater for as at the end of the period. And that's why we needed to consider the arrears. It is the arrears that has brought us to this concept of the 5th year. In order now?
Yes.
Great. Mercy, question?
Yes, Mwalimu.
Yes, please.
When I'm calculating IRR, it's giving me 0, even after following the right procedure. What could be wrong?
It's giving you 0?
Yes.
What have you taken as on IRR? Remember, you're supposed to consider your initial outlay as well.
I have considered.
Have you considered the initial outlay?
Yes.
She should only click on the percentage. Just click on percentage, it will bring that.
Oh, yeah.
Maybe if I told you having one, maybe you could be having, say, like yours is only taking 1 point or 0 point something. Yeah, if you click percentage, it will give you the same, because it was taking like 0.14, alafu maybe it was only 1, where it was bringing only 0. So if you click, it will give you the whole bit. Achieving that?
Yes, thank you.
Right. We have Mark, question?
Mwalimu, from my side, okay, except inserting I'm struggling to insert that arrow to show the point of, that point of intercept.
Oh, this
I've
one,
tried
okay.
inserting from the symbol, but it goes to the formula.
No, you come to insert.
Yes.
then illustration or yours probably would show like so long as you are able to search for the shapes.
Okay, that's fine then.
Then you take that case, okay? You take the shape, then you control the shape where you want to indicate it, okay?
Okay. Thank you.
Great. Great. Welcome. So in this case, Kevin, question?
No. I'm okay.
Great. Annette, question?
Thank you, Mwalimu. I'm fine.
Great. Jeff, question?
No, I'm good, Mwalimu.
Great. Collins, question?
I'm just requesting you share this solution plus the previous solution, the tax solution which we did yesterday.
Great. That I'm going to share immediately after class. Great. Anne Masai, question?
No, I'm good.
Great. Juguna, question? Anne?
No, I don't have a question.
Great. Alan, question?
No, Mwalimu. Thank
And you join the other two devices as usual? Or there's another Anne?
No, I have joined with 2 devices.
Okay, great. So in this case, I believe all of us now we have the concept right. So for case, what if you're asked of PI, profitability index, PI, you might be asked profitability index. So profitability index, remember, we need to determine our present values of cash flows, present value of our cash flows. We divide by our initial outlay. So in our case, if I told you to determine the present value for cash flows, this is very easy. So we have our case. So our present value for cash flows, PV for cash flows, you simply do the NPV formula, equal sign NPV tab. We take our rate that you're given there. Rate, we had the 9.2%, comma, we take our values, but we don't put initial outlay, so that we have the present values of our cash flows. So that we have the present value of our cash flows. We have the present value of our cash flows. Then initial outlay, of course, we had a value of 8 million. So that therefore our PI would be that divided by that to give us 1.12. Profitability index more than 1. Of course, that project is viable. Profitability index less than 1, that project is not viable. Profitability index exactly to 1, it depends with management. They can either consider or they can leave that project. So this one is more than 1. Therefore, the project is viable. The project is viable. Project is viable. Project is viable. Yeah. So that is what we were supposed to consider in relation to the same. Of course, what if you're asked, yes, please. Okay. So Mwalimu is saying that what if you're asked, yeah, discounted payback period. Discounted payback period. If you ask this, discounted payback period. If you're asked the discounted payback period. Someone is trying to ask a question or? Okay. So discounted payback period, you might be asked, right? So remember, this is the same concept. Someone is trying to ask a question or what? Victor, you're talking, you're saying something. Victor, are you saying something?
No, Mwalimu. Maybe it is just the first diamond. Yeah.
Okay. So you're saying that when you talk about the discounted payback period, it is similar to, of course, our other formula, like the normal payback period, where at this point, remember, we just want to look at the aspect of the duration that it will take us to recoup back all our initial investment. Duration that it will take us to recoup back all our initial investment. This is what we are looking at. This is what we are looking at. And majorly at this point, of course, we will always tend to consider the aspect of regular or irregular cash flows, yeah? Regular or irregular cash flows. So it is upon us to have that, yeah? So in our case, for us to talk about the aspect of the regular cash flows, so these are about for regular cash flows, normal payback period. This is for regular cash flows. Mwalimu was saying that this one you're looking at what? Equal cash flows. So how long will it take us to recoup back all our initial investment? We take our initial investment. We're going to divide all this by what? Annual cash flows. This is where we are dealing with regular or equal cash flows. When we are dealing with an equal cash flows, or simply the aspect of irregular, then we have to use cumulative method. Yeah, in this case, cumulative method is easy. Yeah, all we need to do is simply consider full years, the one that you're having, or maybe years before recovery, full years before recovery. You're going to add. With the balance, yeah, that is, of course, consider what are we remaining with, amount remaining to attain our initial outlay. You divide all this by, of course, the cash flow in the recovery year. Cash flows in recovery year. See, so the difference with the normal case, discounted payback will come as a result whereby you are dealing with what? We are dealing with the discounted cash flows. Say, for example, in our case, this is what we have, yeah? I want us to work both the normal and discounted. I want us to consider both the normal and discounted cash flows. Let us consider the normal and discounted cash flows. So let us talk about the normal payback period. The normal payback period, or rather non-discounted payback period. Anyway, we revised all of FM. I only know that we'll have revised everything in FM in this class. So we're about an discounted payback period. So what we are dealing with an undiscounted payback period is that having our cash flows, yeah, right. Having our cash flows at this point, we need to use cumulative method. See, we are considering cumulative method. So these are our years. And these are cumulative method. We are considering a cumulative method. So how would we go about it here? This is cash flows, cash flows cumulative. And you guys to get the difference here. So cumulative, I'll be having that plus that, of course. We've not yet reached our initial outlay. Remember, initial outlay, we had a value of 8 million. Consider that. So we are attaining our initial investment somewhere in year 3. Somewhere in year 3. That's where we are attaining our initial investment. So we take this formula. We take that formula of ours. Consider our full years before recovery. This is 2 years. So 2 plus amount remaining. What are we remaining for us to attain our initial outlay? For us to attain our initial outlay, we are remaining with the value of 8 million minus cumulative just before the year of recovery, which is 4.9. 3.1. We divide by our cash flow in recovery year. The cash flow in recovery year, we have 33.80. So that as at the end of the day, our payback period will be what? 3.1 divided by 33.80. So we take our value here, 2 plus 0.92. So therefore, our payback period, we agree to be 2.92 years. 2.92 years to be our payback period. To be our payback period. 2.92 years to be our payback period. Very important to note. That is the non-discounted payback. What about if at all you're talking about or your ask of discounted payback? Discounted payback period. What if you're asked of the discounted payback period? How will you go about it? discounted payback period, the same aspect will apply. We take these values, we have them at that point. So this time round, I need to determine our discounted cash flows. We need to determine our discounted cash flows. We need to determine our discounted cash flows. Where, given our rate here, given our rate, at that point, we can easily determine our discounted cash flows. Yeah. So we want present value of our cash flows. We want the present value of the cash flows here, right? So we use what? Because you're doing one by one, we're considering our PV tab. Rate, comma, period, we'll determine that to be 1, comma, PMT, we say we will be using that when we are dealing with what? Annuity. Our case, our cash flows, in this case, we're having what? Our cash flows are, of course, irregular. So we don't have PMT, but we have what? The future values for cash flows. Because I want our rate to be constant, we lock our rate. We lock our rate because I want it to be constant. So we lock our rate. So that this case, I have 1. Remember, before values, remember we said always before value, put what? Negative value there, right? Before our values in a formula, we'll always put negative. So that is 1, 2, 3, 4, 5. So that we have it at that point. Discounted cash flows now. So we just drag that all through. So these are our present values, cash flows, discounted cash flows. These are the discounted cash flows. So after that, similar concept will apply. Consider cumulative. It is already 7. Consider cumulative, where we take that value, we take that plus that. Yeah, and we drag it all through. Drag it all through. Drag it all through. If Mwalimu is going fast, say Mwalimu, you're going fast. But remember, these are things that we did, the same things that you're revising. Probably you could have forgotten. Just ask Mwalimu, Simukweli hapa, I need a reminder. So we have our cumulative cash flows. So after that, similar concept will apply. See, similar concept will apply, whereby I'm going to apply this case here. This is what you're going to use. We have year 1, year 2, year 3. So we are achieving our initial investment somewhere in year 4. So we come and take our value here, that is 3 years. If at all you're using discounted cash flows, plus what? You have, of course, our item, that is initial outlay. Initial outlay minus the cumulative there before achievement, divide by the cash flows, of course, cash flows in the year of attainment, so that as at the end of the day, what will we have here? We will take this value, divide by that case. So we have 3.52 years. 3.52 years as a payback period. Discounted, this discounted payback period. We're using discounted cash flows. That is the only difference. That is the only difference. We're using discounted cash flows. Discounted cash flows. Discounted cash flows. So that's it. That's it. Any question? Any question on this? I think we've looked at almost every bit. Probably the element of xNPV and maybe XIRR, where we're considering the rates, the times. But ideally, this is yeah, this was very good. Any question on this? This bit of auditing, I'm not sure if at all you're going to look at it because I'm having another class. The aspect of auditing, remember, and this will be my advice. Of course, so you guys in an exam situation can always consider what you can, so long as you find the question, it is easy on your end. But my advice will always be, yeah, my advice will always be, in the event that you are to select, because in reality, you'll select either the two. In reality, you'll select either the two components. And the component that you'll be selecting here, it is either you select tax or auditing. Remember, for audit, the challenge, not even the challenge, but with the lack of a better word, maybe let us use that term, yeah? For audit, they'll always mark from the answer going backwards, the way it has always been. You check the answer because majorly you'll always be told to prepare the aspect of the TB, or maybe you're told to prepare. Majorly it is always about preparation of the trial balance. So at any given point in time, this is just a secret. The examiner has seen that your trial balance are not tallying. So whatever that will ring at the back of his mind is that there are values on top which are not correct. So this person, what he's going to do, many a times they won't even look at the entries that you've done. So long as I've seen the trial balance are not okay. So many times I won't even consider whatever I've done. My assumption would be, if at all they are not correct, meaning that there's a mess on top there. So if at all a question is located at 20 marks, you might end up getting, it can give you like 4 marks, or maybe you can get a ruthless marker, it give you like 2 marks. See? And that's it. Or maybe if at all you get a linear marker, maybe You'll just look at it and allocate you, say, like 6 marks on some of the common areas. This is where audit usually has a tricky part. So if at all you are in a position, go with tax, because tax, regardless of whatever, regardless of whether you know or you don't know, there are some entries that you'll be very sure of. There are some entries that you'll be very sure of. And in that case, you'll find that regardless of how the question has been tested, regardless of how hard the question is, tax is always made in a way, like if at all a question has been allocated, say like 15 marks, direct entries, so long as you mastered the format, trust me, direct entries will be 11 marks or maybe 10 marks. These are direct entries. If at all the question is given 20 marks, the marks that you can get easily without struggling, they are almost up to 15 marks. And in this case, you'll find that for tax, the examiner has to consider the entries. He has to consider the entries. And there will be a very high chance of you earning a lot of points in tax than in audit. More so audit, where you're asked to prepare the aspect of the trial balances, or maybe you're told to prepare maybe aspect of, it is always about a balance majorly. Maybe 1, 2, or maybe the adjustments and so on. So long as in this case, you'll find that it requires us to do what? Consider something that should balance on either side. So Mwalimu will always advise us, like, not unless you are 0 in whichever question that has been asked in regard to tax, that is where you can go for audit. That's where you can say, like, let me look at 1 or 2 marks in audit. But if at all you're given these statements, you're given, say, VT, you're given all these other elements, kindly consider where you can earn a lot of points. So it's not that audit is hard. Audit is very easy. The only issue is always that for marking purposes, they'll always consider what? Start from the answer. That is the only bit where audit probably you can say that it can be slippery. So this part is what you're going to start with in our next session, the first segment here, like we clear audit. Once we clear with audit, I think audit won't take us more than 30 minutes. Audit will take us more than 30 minutes. Then we come and check what? The published accounts. So I'll share a certain video for published so that we go through it. Or if at all I'll get time, I do this question exactly the way it is. I share with you the same question. Then in this case, we review the video over the week so that when we meet in our next segment, at least in this case, we should be having the same. It will just be like a form of revisions. So kindly go through whatever that you've done. It will help us a lot. To that point, you have a very wonderful weekend, and see you in our next class.
Mwalimu, share the Excel workbook
right away.